October 24, 1929, October 24th. Wall Street looked normal. By lunchtime, millions had disappeared. Not because buildings collapsed, not because bombs fell, not because an enemy invaded, because people suddenly stopped believing. One day, one emotion changed the world forever. I am the mascot of money and power. And I've watched this story repeat itself more times than most historians care to admit. So let's ask the question almost nobody answers honestly. What really happened on Black Thursday? Not the version in the textbooks, the version written in trading floor sweat, bankers' silence, and a lie the entire country agreed to believe. To understand the crack, you have to understand the party before it. The 1920s didn't feel like a warning. They felt like a celebration that would never end. World War I was over, factories were humming, radios were in living rooms, cars were on every street. America had convinced itself of something dangerous. That prosperity was permanent. The market doesn't crash because numbers fall, because people do. Prosperity is permanent, a myth, and nowhere did that belief live louder than on Wall Street. Because in the 20s, buying stocks stopped being something bankers did in private offices. It became something everyone did. Barbers, elevator operators, taxi drivers, housewives. Everyday Americans reading newspapers with stock listings. Here's what almost nobody noticed. The stock market had quietly become the new national religion. And like any religion built on blind faith, it needed believers who never asked questions. Here's where the story gets dangerous. Because most people didn't actually have the money to buy all those stocks, so Wall Street handed them something that felt like magic. It was called buying on margin. Imagine walking into a bank, and instead of buying a $100,000 house with a full down payment, you put down just $10,000. The bank hands you the rest. You don't own the house, you own a promise to eventually pay for it. That's exactly what margin buying was. Investors could buy stocks by paying as little as 10% of the price. Brokers happily lent the other 90%. Why? Because as long as prices kept rising, everyone made money. The investor made money, the broker made money, the bank made money. It felt less like investing, and more like a machine that printed wealth out of thin air. Greed whispers, fear screams, and in 1929, greed was whispering into millions of ears at once. Between 1925 and 1929, the stock market more than quadrupled in value, not because companies were suddenly 4 times more profitable, but because more and more people were borrowing to buy stock in companies whose actual earnings hadn't changed nearly as much. This is the twist most documentaries skip. The stock market wasn't reflecting the economy anymore. It was reflecting confidence. And confidence, unlike a factory or a farm, cannot survive forever on belief alone. Many banks began lending depositors' savings into the stock market itself. The very money regular families kept safe in the bank was being funneled into the same speculative bubble everyone was chasing. Your savings were already in the game. If the market fell, it wasn't just investors who would feel it. It was everyone with a bank account. Regulators saw pieces of this. Some economists warned about it, but warnings don't sell newspapers. Rising stock prices do. So the warnings were buried under stories of ordinary people becoming millionaires overnight. Here's what almost nobody noticed. The system wasn't broken by accident. It was built to reward blindness. By September 1929, small cracks had already started to show. Prices dipped, then recovered, dipped again. Analysts called it a healthy correction. Nobody wanted to say the word everyone secretly feared: crash. It's because admitting the possibility felt like betrayal to your neighbors, to your broker, to the entire optimistic story America had been telling itself for a decade. When confidence disappears, money follows. Then came October 24th. Now imagine walking onto Wall Street at 9:30 in the morning. The air is crisp. Newsboys shout headlines about football scores, not financial doom. Traders arrive. Coffee in hand, expecting an ordinary day. Nobody knows. History is about to change. At 10:00 a.m., the opening bell rings, and almost immediately, something feels wrong. Sell orders start pouring in, not a trickle, a flood. And here's the detail most people never learn. The ticker tape machines. The devices meant to report prices in real time couldn't keep up. They fell behind by minutes, then by an hour, which meant something terrifying. Nobody actually knew what stocks were worth anymore. Traders were reacting, not to real prices, but to outdated numbers and their own fear of what the real numbers might be. The market wasn't collapsing. Trust was. Word spread through the city like fire through dry grass. Crowds began gathering outside the New York Stock Exchange, not to celebrate, to watch, some even said, to witness the end of something. By mid-morning, nearly 13 million shares had been sold. A number that just weeks earlier would have seemed impossible for an entire week, let alone a few hours. Panic doesn't ask permission, it simply arrives. And on the morning of October 24th, 1929, it arrived all at once. Wealthy bankers walking briskly into a private meeting room by early afternoon. The panic had become dangerous enough that Wall Street's most powerful men had to act. A group of major bankers, including representatives from firms like J.P. Morgan and Co., met privately. Their solution? Show confidence. Even if they didn't fully feel it themselves. Richard Whitney, a well-known exchange figure acting on the bankers' behalf, walked onto the floor. He didn't rush. He didn't panic, he walked. Deliberately, calmly, almost theatrically. He placed a large, visible buy order for U.S. Steel stock at a price higher than the current market price. Then he did the same for several other major companies. A performance of confidence. It wasn't really about the money. It was about the message. See, someone still believes, and it worked for a while. By the end of the day, losses had been partially recovered. Newspapers the next morning even called it a success. Here's the twist most people never hear. Black Thursday wasn't actually the crash. It was the warning shot. History didn't repeat itself. It simply changed clothes, because 5 days later, the fragile confidence the bankers had performed collapsed completely. On October 28th, a day that would come to be known as Black Monday, the market fell nearly 13%. There was no theatrical buy order this time, no calm walk across the floor, just selling, relentless, panicked selling. Then came October 29th. Black Tuesday, over 16 million shares changed hands. A record that would stand for decades. By the time the dust settled over those few days, billions of dollars in value had vanished. Some estimates put the losses at over $30 billion in 1929 dollars. Adjusted for today, that number becomes almost incomprehensible. The market doesn't crash because numbers fall. Numbers fall because people do. And people, millions of them, were about to fall very hard. Here's where the story stops being about stock tickers and starts being about kitchen tables. Because the crash didn't stay on Wall Street, it moved outward like a shockwave. Banks that had lent heavily into the market started failing. When banks failed, they took ordinary people's savings down with them. Remember, this was before deposit insurance existed. If your bank collapsed, your money simply disappeared. Businesses that depended on credit suddenly couldn't get loans. Factories slowed production. Then they laid off workers. Those workers stopped spending, which meant more businesses struggled, which meant more layoffs, feeding itself downward. Within a few years, unemployment in the United States would climb above 20%. Families lost homes. Farmers lost land. Children went without meals that used to be ordinary. The Great Depression begins, and it didn't stop at America's borders. Because the global economy in 1929 was already deeply interconnected. American banks pulled back loans to European countries. European economies, still recovering from World War I, buckled under the pressure. Trade slowed worldwide. One emotional collapse, on one trading floor, in one city, became a decade-long global catastrophe. So what's the lesson history keeps repeating, that most people conveniently forget? It's not really about stock prices. It's about the story people tell themselves before the fall. In 1929, the story was, prosperity is permanent. In 2008, the story was, housing prices never go down. Different decade. Different asset, same emotional machine. Greed convinces people that risk has disappeared. Fear later reminds them it never did. Greed whispers. Fear screams. Today, the tools have changed. We don't need ticker tape anymore. Prices update in microseconds now, but the emotional pattern underneath it all, untouched by a single century of progress, confidence rises, spreads, becomes belief, becomes blindness. Then something small cracks it, and the fall is never about the crack itself. It's about how much unstable belief was standing on top of it. Here's what almost nobody noticed. Black Thursday wasn't caused by bad luck. It was caused by an entire system quietly agreeing to ignore its own warning signs. Because the warnings were inconvenient, that pattern hasn't disappeared. It's simply waiting. The next financial crash won't begin with numbers, it will begin the exact same way, with belief. If history teaches anything, it's that those who understand money are the ones who survive when everyone else panics. Subscribe to Money and Power, because the next lesson from history may save your future.